Hi, I'm Harold Laudine, CEO and Wealth Advisor at Mercer Wealth Management. I'm here as a resource for you and a bridge between your employer and your 401k provider. In the past, we've conducted live presentations in person for you, the plan participants. While effective, it excludes participants who are unable to attend and did not offer anyone the ability to revisit the information in the future. To accommodate this, along with evolving remote work policies, we decided to produce recorded presentations on a quarterly basis going forward for your benefit. Today, we'll be talking about the risks of investing that come along with potential rewards. We'll also review ways you can manage them to help you achieve your goals. I'm excited to share this information with you today. Let's get started. Today, you'll learn different kinds of investment risks and ways to avoid them, key strategies that can help you manage risk, asset allocation, and its relative diversification, how to identify your investing style, which is an easy first step to help you make investment decisions, and how to select an investing strategy that fits your goals. So, what exactly is investment risk? To put it simply, investment risk is the possibility of a negative financial outcome when you invest. For example, there's a chance your investments could lose value or have lower performance than you expect. All investing carries some risk, but along with risk comes the potential for your money to grow. From a bird's eye view, there are two main categories of investing risk: systematic and unsystematic. Systematic risk is risk that affects the entire market. It's a natural part of investing caused by factors beyond our control. For example, if economic conditions change or interest rates go up or down, it can impact the whole market. Political events and natural disasters are other examples. While you can't eliminate or avoid this kind of risk, you can manage it. We'll talk about this today. Unsystematic risk typically affects only a certain company or industry. So if you invest in those particular ones, you may take this kind of risk. It's caused by factors from within an organization or industry, such as company management or financial issues, changing industry regulations, or new competitors entering an industry. You can eliminate unsystematic risk, but you can avoid and manage it. We'll talk about this too. Understanding these risks matters because it can help you reach your retirement goals. Knowing what the risks are can help you avoid some while accounting for others. Today we'll discuss 5 specific kinds of risk. The first 3 fit into the systematic risk category: market, inflation, and interest rate risk. The last 2 are more specific to you: longevity risk, which has to do with how long you live, and investor error risk, which is related to your personal investing choices. Let's dive in. Market risk is the first type of risk many people think of when investing. It's the risk that investments could lose value because of factors that affect the whole market. As I mentioned, factors such as changes in the economy or politics can affect the market overall. While market risk can't be eliminated or avoided, consider what history shows. Despite periods of volatility, $1 invested in 1970 would have been worth almost $218 in 2023. The market has generally gone up over time. That can work to your advantage in the long run. The second one, inflation risk, is the risk that your investment returns won't keep up with inflation. As you are probably well aware, inflation is the general rise in price for goods and services. It's always fun to look at your statement when the market is good and think, wow, look at the balance. However, you also have to consider what these dollars may be worth in the future. As you can see on the chart, things today cost more than they did in the past, and will likely cost more in the future. That reduces your purchasing power, meaning you can't buy as much with the same amount of money. It's important to think about how likely your investments are to grow and how much they may grow. Having some investments with higher growth potential, such as stocks, could help cushion you from the effects of inflation. Interest rate risk is the chance that a change in interest rates could reduce the value of an investment. This kind of risk mainly applies to investments with fixed interest rates, such as bonds. When you purchase a bond, you're loaning money to a company or government that agrees to pay it back at certain interest rate. When interest rates rise, new bonds being issued pay higher rates. So existing bonds that pay lower rates aren't worth as much, and their prices fall. The strategies we'll talk about today can help offset this risk. The fourth kind of risk we'll talk about is longevity risk, the risk of outliving your money. Since no one knows exactly how long they will live, this affects everyone. While you can't know for certain the number of years you'll need your money to last, a few things can guide you. One is something you have control over, your planned retirement age. Another is your family history and your health. You can also consider general life expectancy. For someone born today, the national average life expectancy is age 80 for women and 75 for men. The U.S. Census Bureau expects it to go up. By 2030, average life expectancy could be about 84 for women and 82 for men. By 2060, these numbers could reach 87 and 85. There are practical steps you could take to reduce longevity risk. The first is contributing the most you can to your retirement plan now so your money has time to grow. You might even consider reducing spending now in order to save more. You can also plan to delay claiming a Social Security retirement benefit if you qualify for one. According to the government's guidelines, your full retirement age is based on your birth year and may be either 70 or 66 or 67. While you could claim it before then, the amount you'll receive will go down depending on when you do. If you file at 62, the earliest allowed age, your benefit will decrease by 30%. On the other hand, you receive 8% more each year you wait to claim past your full retirement age, up to age 70. Unlike many of the risks we've discussed so far, you have control over this one, investor error risk. It's the risk of making crucial mistakes when investing. There's more than one kind of error investors can make. We'll go over some of the most common: emotional investing, trying to time the market, procrastination, and neglecting something called asset allocation. For now, let's go over these first two errors in more detail. Emotional investing is when you let your emotions, such as excitement, fear, optimism, and anxiety, affect your investment decisions. For example, when the news says the market's going down and you see your account balance drop, you may be tempted to pull the money out of the market. On the other hand, if the market goes up, you may be tempted to buy investments, hoping to take advantage of an upswing. The graphic shows how most of us feel when we're watching our account balances fluctuate. Remember, if the market drops and you stay invested, the losses are only on paper. But if you sell, the losses are locked in. You could miss out on returns when the market rises. On the flip side, if you follow the next big thing and buy investments when prices are high, you may overpay. In that case, you may not earn a profit on your investments. You could also lose money if the value of an overpriced investment falls to reflect its true value. That leads us to another kind of investor error: trying to time the market. Going in and out of the market can be costly. That's because the market's best days often occur shortly after the worst ones. If you pull money out of your account to try and avoid a downturn, you may miss out on the upswings and the gains that come with them. As you can see on the chart, not being invested during even a few of the best days could have a huge impact on your returns. It's generally best to stay the course and ride out market swings. In fact, staying invested in a market downturn can give you an opportunity. When the market is down, you can buy more investments with the same amount of money. By making regular contributions to your retirement plan, you buy more shares when prices are low and fewer when prices are high. That's called dollar cost averaging, or DCA. The key is to be consistent and stick with your contributions. The more you stick with this approach, the more dollar cost averaging can work for you. Another kind of investor error risk is procrastination. It simply means putting off saving for retirement or other investing goals. Procrastinating can reduce the amount of money you have when you retire, for instance, because there's less time for your money to grow. This example illustrates the benefit of starting early. If a 25-year-old investor starts making contributions of $100 per paycheck and commits to increasing them by $25 a paycheck each year, she could accumulate more than $1 million by age 60. That's due to something called compounding, which means that your earnings get reinvested and generate more earnings of their own. Time is a key ingredient that allows this to happen. So the sooner you start saving for retirement, the more compounding can help you reach your goals. The last investor error risk is neglecting asset allocation, which leads us to the next part of our presentation, key ways to manage risk. Asset allocation is how you divide your investments among different categories of assets like stocks, bonds, and cash. It's useful for managing systematic risks like market, inflation, and interest rate risk. You may have heard the old adage, don't put all your eggs in one basket. That same idea applies to investing. Spreading out your investments can reduce risk. It's one of the best ways to control how much risk you take on. Most people worry more about how to select their specific investments rather than how to allocate them. But most financial professionals agree that asset allocation is one of the most important decisions an investor makes. In order to spread out your investments or allocate your assets, you need to know about the three main asset categories: stocks, bonds, and cash or cash equivalents. All three categories have different levels of risk and potential returns on earnings. Stocks are shares of ownership in a company. In general, they're more volatile and have higher risk than the other two. They also offer the most potential to grow. As I mentioned earlier, bonds are loans you give to the government or a company. They're historically less volatile and risky than stocks, but the returns are typically lower. They're also more sensitive to interest rates, as we talked about before. Cash and cash equivalents, like bank accounts or certain short-term investments, can be converted to cash quickly. They come with the least risk and are generally considered safer than the others, but they usually have the lowest returns of all three. To decide the best way to allocate your assets, you need to know the type of investor you are. That's known as your investing style. Simply put, it's the approach you use to choose investments. Your style is based on a few things, including your time horizon, risk tolerance, and investing goals. First, consider how long you have until you need to start withdrawing from your retirement account. You may want to begin as soon as you retire, or wait until you've been retired a few years. If you don't know, take that into account and plan to modify your approach later. Generally speaking, the farther away you are from needing your money, the more aggressive your investing style can be. Next, consider how comfortable you are with the idea of your investments losing value. Your comfort level with the risk of losing money indicates how risk tolerant you are. If you get anxious every time the market goes down and want to change your investments, you might have a low tolerance for risk. That means your style may be more conservative. Lastly, think about what you're trying to achieve by investing. Having clearly defined goals can guide your decisions. Be sure to think about that. Maybe you want to save enough to retire at a certain age, or maybe you're saving money for a child to go to college. In both cases, you probably want your money to grow. That's an investing goal. On the opposite end of the spectrum, maybe you're close to retiring or already retired. You may be more interested in preserving the value of your investments. That's a goal too. To help identify your style, let's review common investing styles. Think about which one fits you best. An aggressive investor is typically far from retirement, very comfortable taking financial risks, and wants to pursue high growth from their investments. A moderately aggressive investor might be far from retirement, comfortable with taking financial risks, and want to pursue above average growth. A moderate investor is more middle of the road. This person may have a while before retirement, feel okay with a limited amount of risk, and be looking for average growth. A moderately conservative investor may have a few years until they retire, be okay with a small amount of risk, and be willing to accept lower returns, in order to minimize losses. Finally, a conservative investor might be close to retirement and need to minimize risks to protect the value of their investments. They're willing to accept low returns to help keep the value of their investments safer. Once you know your investing style, you can use it to guide your allocation. Spread out your investments in a way that fits your time horizon, risk tolerance, and goals. Let's look at the chart to see how this might work with your retirement plan contribution. Retirement plans generally contain types of funds like the examples on the chart. These funds are made up of assets like stocks and bonds. On the left, you'll see funds that have higher risk with higher potential returns. On the right, you'll see funds and short-term investments like cash and cash equivalents that have low risk and lower potential returns. Other funds that have average risk and potential returns fall toward the middle. To allocate assets in your plan, you could spread your contributions among these fund types. That way, you have varying levels of risk and return built in. When the market shifts and one type of fund is affected, the others may not be. The allocation that will work best for you may change over time. For instance, it can shift as your risk tolerance changes or retirement gets closer. Here are some specific asset allocations that can fit different investing styles. These pie charts show the investing styles we talked about, from conservative to aggressive. The list at the bottom shows different types of investment funds that all have different amounts of risk and potential return. If you look closely, you'll notice that the pie charts for each investing style have different percentages of these funds. Those different percentages determine how much risk and return potential are baked in. On the left, the conservative pie chart has a high percentage of funds with low risk. That allocation fits someone with low risk tolerance and a short time until retirement. On the right, the aggressive pie chart has a higher percentage of funds with higher risk. That allocation fits risk takers who have a long time until retirement. Most people fall somewhere in between. A second strategy for managing risk is called diversification. It's related to allocation. Excuse me. And using them together is a powerful way to minimize risk. However, unlike asset allocation, diversification helps with unsystematic risks, the ones that affect only a certain company or industry. It's also a good strategy for managing interest rate risk. To put this strategy into context, asset allocation is how you divide your investments among asset classes. Does anyone remember what they are? That's right, stocks, bonds, and cash. But diversification goes a bit further. It divides your investments within each category. As a broad example, let's say you wanted to buy stock. You might buy stocks in different size companies in different industries. That way, if a stock in one industry isn't performing well, others might be faring better. Inside your retirement account, diversification might look like what you see on this chart. Instead of investing in only one fund in each category, you invest in 2 or 3. For example, you might invest in 3 international funds rather than 1. That way, if a specific fund isn't doing well, you have others to fall back on. In your qualified employer plan, there are investment options called target date funds. Target date funds simplify managing risk. You invest in one fund that has asset allocation and diversification built in. Professionals build these funds using the options available in your plan. They're designed to gradually become more conservative as a target date approaches. They automatically rebalance over time, meaning asset allocation changes to stay in line with the fund goals. Your role is to simply select the target date fund that most closely aligns with the year you plan to retire or start withdrawing from your account. For example, if you think you want to start taking distributions in 2041, you could select the target date 2040 fund. If you don't make a fund selection when you enroll in your plan, you may be defaulted into a target date fund closest to the year in which you'll turn 65. Now that you know more about investing risks and how to manage them, you can apply what you learned by taking the next steps. First, don't forget to enroll in your retirement plan if you haven't done that. It's a crucial starting point for investing in your future. Next, log into your account. It will help you choose your investing style and asset allocation. Then, be sure to select appropriate primary and contingent beneficiaries as well. Also, don't forget to continue increasing your contributions inside the account. The sooner you invest, the more time your money has to grow. Thank you for your investment of time in watching this educational video. Until next time, invest intelligently and remember to grow with guidance. Thank you.